Hey everyone, and welcome back to the channel where we decode the complexities of the market. Today, we're diving deep into the fascinating world of hard-to-borrow stocks and potential short squeeze candidates. We're going to break down exactly what makes a stock hard to borrow and what that could mean for its price action, using a real-world example, the stock ticker BIYA. But before we get started, please remember, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Alright, let's talk about BIYA. This stock recently popped up on our hard-to-borrow screener, and it's a microcap company. The sector for BIYA isn't readily categorized at the moment, but the numbers that caught our attention are certainly worth discussing. In terms of recent price action, BIYA has seen absolutely no movement to date, registering a plus 0.0% change. Looking back, over the last 5 days, it's also flat at plus 0.0%, and the last 30 days show the same plus 0.0% change. Similarly, the volume data is striking. Today's volume is 0 shares, the 30-day average volume is 0 shares, leading to a relative volume of 0x average. Now, this lack of trading activity is critical context as we dive into its hard-to-borrow status. What is cost to borrow and why it matters? So, what exactly does cost to borrow mean, and why is it so important for understanding potential short squeezes? Simply put, when you want to short sell a stock, you first have to borrow shares from someone who owns them. The cost to borrow (CTB) is the annualized interest rate you pay to borrow those shares. When a stock becomes hard to borrow, it means there's a scarcity of shares available to lend out. Imagine a small pond with only a few fish, and suddenly everyone wants to go fishing. The price to rent a fishing rod would skyrocket. That's what happens with borrow fees. When demand to short a stock is high, or the supply of shares available to lend is low, these fees can surge, sometimes exceeding 100% or even several 100% annualized, as we're seeing with BIYA. This isn't just a small fee, it's a significant ongoing cost for short sellers. Why this stock is hard to borrow right now? Now, let's get specific with BIYA. Our screener shows an annualized cost to borrow fee of a staggering 752.5%. That's an incredibly high percentage, signaling extreme scarcity in the borrow market for BIYA shares. We currently don't have data on the momentum of the CTB fee or the exact number of shares currently available to borrow, but the fee itself is a huge red flag. The estimated float for BIYA is also quite small, or around 2.7 million shares. A small float means fewer shares are available for public trading, which can make it easier for borrow rates to spike if there's any short interest or lending scarcity. Our internal composite squeeze score for BIYA currently sits at 40.6 out of 100. While not extremely high, it indicates some underlying pressure from these borrow dynamics, even with the current lack of trading activity. Squeeze mechanics explained. So, how does this all tie into a potential short squeeze? A short squeeze occurs when the price of a heavily shorted stock rapidly rises, forcing short sellers to buy back shares to limit their losses. This buying action further pushes the price up, creating a vicious cycle for shorts. When a stock's cost to borrow is extremely high, like BIYA's 752.5%, it puts immense pressure on short sellers. They're paying exorbitant daily fees to maintain their positions. If something were to cause the stock price to start moving up, perhaps positive news, unexpected volume, or simply renewed interest, those shorts would face a double whammy: rising share prices and huge ongoing borrow costs. This can force them to cover their positions, meaning they have to buy shares back in the open market, regardless of the price, to return them to the lender. This demand to buy can create a powerful upward price spiral. Show chart illustrates theoretical squeeze with volume spike, however, and this is crucial for BIYA. A squeeze requires volume and price action. With BIYA currently showing 0 shares traded and no price change, despite the high CTB, there is no active squeeze in progress. The high CTB here might reflect an extreme liquidity of the stock, where shares are simply unavailable to borrow, rather than a massive influx of short sellers willing to pay that rate. Dilution risk check. When evaluating any potential squeeze play, understanding dilution risk is absolutely essential. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding and can decrease the value of existing shares. If a company with a high cost to borrow issues a lot of new shares, it can flood the market, providing ample supply for short sellers to cover their positions, thus negating any potential squeeze. For BIYA, our checks found no recent dilutive SEC filings like SMINUS 1s, SMINUS 3s, or 424 BS in the last 90 days. We also found no recent reverse splits in our look-back window. This is a positive sign, as it means the company isn't currently adding new supply that could undermine a squeeze thesis. Just a quick reminder before we continue, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, given BIYA's current state of zero volume and zero price change, what should you watch for if you're interested in understanding this stock better? First, look for any increase in trading volume. Right now, with zero shares traded, there's no market activity. A sudden, sustained spike in volume would be the first indicator that interest in BIYA is changing. Second, watch for any price movement. As we discussed, a short squeeze requires upward price pressure. Third, keep an eye on borrower availability and cost to borrow updates. While the CTB is extremely high, if more shares become available to borrow, or if the CTB starts to fluctuate, that could signal shifts in the market's perception or liquidity. Remember, a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have strong conviction and are willing to pay a premium to maintain the bearish stance, or simply, as may be the case here, that the stock is incredibly illiquid and there are simply no shares to lend out. In summary, BIYA presents an interesting case study. It has an exceptionally high cost to borrow of 752.5% annualized and a relatively small estimated float of 2.7 million shares, which are characteristics often associated with hard-to-borrow stocks and potential squeeze candidates. However, it's absolutely crucial to remember that BIYA currently exhibits zero shares traded, zero average volume, and 0% price change. This means that while the potential for scarcity is evident in the borrower fees, there's no active trading or short covering happening at this moment. For any short squeeze to materialize, we would need to see a significant and sustained increase in trading volume and positive price action. Always approach these situations with caution, conduct thorough due diligence, and consider the broader market context. If you found this explanation helpful, please smash that like button, subscribe for more in-depth market breakdowns, and let us know in the comments if you have any questions or other tickers you'd like us to analyze. Thanks for watching, and we'll see you in the next one.